Welcome to this year's first half Kenya market update. This report provides an overview of Kenya's real estate market performance. It reviews retail, office, residential, hotel, tourism, industrial and institutional property segments against the country's economic performance over the first 8 months of this year. Our head of research and a selection of our key experts will guide you through an overview of our report's findings, including the current economic trajectory of the country, inflation eclipsing the CBK ceiling, Kenya shilling depreciation, and the surge in diaspora inflows. The continuation of large-scale development and infrastructure projects, including the new railway city, our road network growth, and hopefully a refurbishment of JKIA.
Kenya's GDP is projected to grow by 5.5% in 2022 and 5.2% in 2023. These projections are much lower than the 7.5% growth recorded in 2021, which was primarily driven by the reopening of the economy, the recovery of the services sector, as well as expansion in industrial output. The reason for the slower growth is that internationally, economic recovery from the pandemic continues to be offset by the impact of the war in Ukraine. This has definitely clouded the outlook for the global economic recovery, and locally, the economy remains vulnerable to commodity price shocks resulting from the war, particularly through fuel, fertilizer, wheat, and other food imports. In addition, global financial conditions have also tightened, sharply increasing external financing costs. Other risks to the outlook domestically include the current drought, which is having a negative effect on food security, high debt levels, and the finalization of the general elections. These factors have all contributed to reduced investor activity, increased inflation rates, and depreciation of the Kenyan shilling that has ultimately resulted in increased cost of living. Future economic stability will depend greatly on international events, as well as the fiscal and monetary measures put in place by the incoming government to cushion the economy. The 33% drop in the value of building plan approvals in Nairobi for 2021 mirrors the shocks of the macroeconomy and the challenges being faced across traditional real estate sectors. This has resulted in investors scaling down their operations or shelving them altogether, thereby adopting a wait-and-see approach. However, we expect the value of building plans to steadily improve in the long term as the economy continues to recover and as supply of various asset classes reduces.
Kenyan capital market scene is a very interesting place right now. Having been in a place where it's been immature, lack of transparency, we're starting to see that market change. There is an increasing amount of transactions happening in the market. There are more properties for sale, and we are starting to see more investors both locally and internationally starting to look at the market. In addition to which, if you look at government bonds and the returns that an investor can get from a government bond, which have generally been in the region of 12 to 14%. If you consider that prime yields for real estate have been anywhere between 8 and 9% as the generally acknowledged market norm, investors have struggled to invest in real estate based upon the alternative asset classes where they can get improved yields. The interesting thing that I can just starting to see emerging in the market is that there have been a number of assets which have been marketed recently, and prime good assets. And there has been investor interest both locally and also internationally. And so I start to envisage that we're going to see some yield shift. Yields that have historically, as I said, been between 8 and 9% are now moving between 9 to 10%. And actually in some instances, investors are actually bidding double-digit yields. And I'm talking yields from between 10 to 12%. And as a result of that, I actually see the next couple of years as being an exciting time as more investors look at Kenyan assets and more deals start to happen.
Major investment in infrastructure continues to be primarily funded by the central government, with approximately 212 billion Kenya shillings allocated to roads alone in 2023 compared to 183 billion allocated in 2022. More recently, the private sector is looking to invest in infrastructure through various avenues, such as joint ventures, private-public partnerships, as is the case for the 80 billion Nairobi Expressway. If history is anything to go by with the Thika superhighway and the various bypasses, infrastructure improvements will continue to have a positive impact on real estate activities, and so will the Nairobi Expressway. This positivity will not only be experienced along the corridor, but also the specific areas which it serves, namely the southern and western parts of the capital. Increased development and transactional costs, however nominal, in relation to the overall development cost, will definitely impact the industry negatively. With the reintroduction of the environmental impact assessment fees, that is 0.1% of the total project cost, an increase of capital gains tax from 5% to 15% of the net gain will eventually result in increased property prices.
The office sector finds itself in a really interesting place as we emerge in the post-pandemic era. What we've seen, really interestingly, in the last quarter, last 6 months, has been the office market rebounding in a really positive way. The position we have with rents is prime rents we've got at $1.20 per square foot per month. I envisage that to come under pressure, and I envisage rents to start increasing. We're starting to see a two-tier market emerging in the Nairobi market, with best-in-class grade A space starting to become more scarce, and we're starting to see one or two occupiers actually starting to compete for some of the best spaces available in the market. The biggest challenge is in the more grade B space, and the rents there are significantly under pressure going downwards. And so everybody talks about an oversupply situation, and there is an oversupply in grade B, but at the best in class in grade A and in the best schemes, there are certainly some chances for some rental improvement and rents to increase, which is the first time we've seen that since 2015-2016. Occupancy rates across Nairobi over the course of the last half have in fact actually decreased from our previous reporting. We had previously said occupancy rates had returned to 78%. We're now down to 72-73%. The occupancy rates in the grade A and the best class offices has in fact increased. Take-up has been good, and we're starting to see those occupancy return to north of 80% as the occupiers continue a trend of seeking best-in-class offices. One of the other key things that we've seen, and the developers are starting to react to it, is an emphasis on amenity space. Occupiers are very much demanding and looking for amenity space within their office spaces that they're taking. And by amenity spaces, I mean breakout areas, gym spaces, and cafe and collaboration areas. And as I see things moving forward, developers are going to react to this by introducing these themes to new buildings as they come to the market. And we're going to see more of a mixed use feel in some of the bigger developments that emerge moving forward. So the retail market, much maligned over the COVID period and the pandemic. A key theme that we've seen, or trend that we've seen emerging over the last 6 months or even the last year, has been the emergence of convenience retail. Kenya, and particularly Nairobi, has been dominated by large formal existing shopping centres and the consumer going to those. And it's all about catching the consumer on his return from home or on his journey, allowing them to stop in on their way home. And as a result from that, we've seen an expansion from existing Kenyan retailers, in particular the supermarket and grocery orientated retailers. And that's where we've seen some expansion.
The first half of 2022 has seen some positive signs, with prime residential sales improving by 1.2% in the first half until June 2022. This can be attributed to the reopening of the economy and a sense of getting on with life after a couple of hard years due to COVID. Although positive, it is a slight decline because in Q1 2022, we saw a 2.4% rise. So the general election has slowed the market a little bit. On the other hand, rents have declined by 2.23%. This is a continual decline, mainly due to an oversupply in the market. There's still a huge amount of supply and a little demand. What have we seen in the residential investment market? One big joint venture we've seen between Gateway Real Estate Africa and Verdant Venture to build a Roslyn Ridge residence, a 90-unit diplomatic community, wholly leased for 8 years to the US Embassy at a total cost of $5.52 billion. We're expecting completion in Q3 2022.
The hospitality industry has seen strong performance across the first half of the year, only slowing slightly in the lead up to the August elections. This is due to the resurgence of international leisure travel, as well as the domestic market looking to explore the country post-COVID, as well as the high cost of international travel. The local market kept a trickle of business coming into the sector during COVID, but has subsequently injected significant income, particularly in the F&B space, with operators seeing record results in the months leading up to the elections. Improvements in security, a massive increase of supply in new international quality offerings, as well as infrastructure developments have made Nairobi a popular location for the startup community. This has spawned a huge increase of work permits and growth in the expatriate community. In spite of the large number of hotels opening, the market has sufficient demand to cope with the additional supply.
ESG is a fast developing topic that is increasingly informing the performance of real estate markets and valuations. While the social and governance pillars are still at nascent stage, there is compelling evidence that the environmental aspects are impacting real estate investing and valuations. The International Valuation Standard Council, in its perspective paper on ESG and real estate valuation, has demonstrated how ESG is influencing real estate investing and therefore valuations. There is general expectation that buildings that minimize environmental impact in all parts of the building's life cycle and focus on improved health for their occupiers may retain value over a longer term than those which are not. Nearly all the typical valuation inputs are influenced by ESG. The notable ones are rental income, voids, operational and capital expenses, capitalization and discount rates. There is research showing that buildings with good ESG ratings attract premium rents, known as green premiums. Even when such premiums are not yet evident, poorly rated buildings are seen to suffer rent discounts, referred to as brown discounts. Occupying ESG buildings is seen to contribute to the occupier's overall ESG rating, and this is expected to translate into reduced voids in buildings with good ESG ratings. When occupiers prefer to occupy green buildings, that translates to pressure on owners of buildings with poor ESG ratings to adapt them. In the process of valuation, valuers must pay due regard to the capital expenditure involved in retrofitting and adapting such buildings. Furthermore, green buildings are known to have better resource utilization, especially water and energy. The low operating expenses translates to better cash flow to the landlord and a reduced service charge cost to the occupiers. More so, since real estate with high ESG rating is seen as more resilient, valuers are expected to compute and apply discount rates and cap rates that reflect the reduced risk profile. While conducting a valuation of a proposed development or completing a project feasibility study, valuers are now having to accommodate ESG features and design while consolidating the overall project cost. Further, we have noted the availability of favorable ESG-focused funding. For instance, energy-efficient mortgages and green bonds are cheaper and favorable than most onerous sources of finance, and these may translate into otherwise enhanced viability, including higher return on projects and equity.
If you look globally, the industrial sector has been the most resilient over the COVID period, fueled by e-commerce and a lot of those occupiers taking more and more space as e-commerce thrives globally. And Kenya is now starting to see a little bit of that starting to impact on our own market here. In our report, we state that rents have increased, but it's a marginal increase. We've moved from 68 Kenya shillings per square foot per month to just over 70 Kenya shillings per square foot per month. And I think that is fueled by that global sort of phenomenon of e-commerce and this sector being very defensive, and as a result of that, investor demand for best-in-class industrial is really quite substantial.
With the pandemic exposing the risks of traditional asset classes, investors have begun shifting their focus to alternative investments that have proven to be more resilient. This includes specialty operational real estate that generates higher yields than traditional asset types. In Kenya, these are still at their early stages of development and include sectors such as data centers, healthcare, student housing, cold storage, senior housing, and infrastructure. Confidence in the purpose-built student accommodation continues because of the various investment avenues created to capitalize on the existing opportunities of an educated, youthful population. For the data center market, the growing need for data that was boosted by the pandemic has resulted in an increased interest in the untapped sector by largely international investors. Affordable housing will continue to thrive with over 35,000 units under development based on the inherent demand in addition to the various investor incentives. The outlook seems positive for these sectors, with a steady supply pipeline coupled by an effective demand from end users.